This week on Euro to US dollar, many traders will get trapped. Not because they don't know how to trade, but because they will react too fast. They will see price break a key level. They will feel the momentum. They will enter with confidence. And minutes later, they will watch the market reverse. That right there is a false breakout. And if you don't understand it, you will keep donating money to the market. Let me show you how to avoid it. A false breakout happens when price moves beyond a strong support or resistance level, but fails to continue. It breaks. It triggers entries. It activates stop losses. And then it reverses sharply back inside the structure. It's not random. It's liquidity. Above resistance, there are buy stops. Below support, there are sell stops. The market knows this. Large players need liquidity to enter positions. They cannot just click buy or sell with massive size. They need orders sitting in the market. So price is pushed beyond a level where retail traders place stops. Stops are triggered. Liquidity is collected. And then the real move begins, usually in the opposite direction. That's why false breakouts feel personal. Because you entered exactly where they needed you to. Now let's talk about trend lines. Trendline support is drawn by connecting higher lows in an uptrend. It acts like a rising floor. Trendline resistance is drawn by connecting lower highs in a downtrend. It acts like a falling ceiling. The more times price respects a trendline, the more traders trust it. And the more traders trust a level, the more liquidity builds around it. That makes it a target. When a strong trendline finally breaks, most traders panic and flip their buyers instantly. But here's what I do differently. I never trade the first break. Never. I wait for the candle to close. Not the wick. The close. Then I watch the next candle. If price breaks above resistance but quickly closes back below, that is not strength. That is rejection. If price breaks below support but immediately reclaims the level, that is not bearish continuation. That is a trap. My secret technique is simple. Break. Close. Retest. Failure. If the breakout holds above the level and structure shifts with strong momentum, then it's real. But if price cannot stay above the level it just broke, I prepare for reversal. Patience is the edge. This week on Euro to US dollar, pay attention to major psychological levels. Round numbers like 1.0700, 1.0800, 1.0900, 1.1000. These are magnets for liquidity. Watch previous daily highs and lows. Watch range highs if price has been consolidating. If price spikes above a previous high during London or New York session but fails to hold, that spike could be a liquidity grab. Do not chase it. Let the market show its hand first. Most traders lose because they trade emotion. They see movement and they react. Professionals wait. They let the breakout prove itself. If it breaks and holds, trade continuation. If it breaks and fails, trade the reversal. But never trade the breakout blindly. The market punishes impatience. This week, stay disciplined. Let liquidity reveal itself. And when the trap is exposed, that's when you strike. I see you at the top. You say you want to be a profitable trader. But every time stop loss hits, you collapse emotionally. That's the truth. The market doesn't destroy you. Your reaction does. A man crosses you on the road. You get angry. Why? Because you created a story. He disrespected me. He's stupid. He thinks he owns the road. But you don't know that. Maybe he's rushing to save a life. Maybe he's dealing with something bigger than you. The event didn't hurt you. Your interpretation did. Now bring that into trading. You hit stop loss. Immediately the voice starts. I'm tired of losing. This market is manipulated. I need my money back. No. You don't belong in business. Listen carefully. The market does not care about your ego. It does not care about your feelings. It does not owe you a win. Your job is not to win every trade. Your job is to execute without emotion. And here's where most of you fail. You frown when you lose. You tense up. Your breathing changes. Your body enters war mode. And your nervous system says, danger. Get it back. Attack. That's revenge trading. That's weakness. Here's the discipline. Stop loss hits. You smile. Yes. Smile. Not because it feels good, but because you refuse to let your body program itself to fear loss. You widen your lips. You relax your shoulders. You breathe slowly. You teach your nervous system. This is normal. This is expected. This is controlled. That is emotional intelligence. Not pretending you don't feel frustration, but feeling it. And still executing correctly. Amateurs trade to feel good. Professionals trade to follow process. Big difference. One trade loss does not mean you lost. One red candle does not define your career. But one emotional decision can destroy your account. You don't need a better strategy. You need a stronger mind. Because at the highest level, trading is not about charts. It's about identity. Are you reactive? Or are you disciplined? Are you emotional? Or are you composed? Are you trading the market? Or fighting your own ego? If you can master the space between event and reaction, you become dangerous. Not to the market. To your old habits. Control your thoughts. Control your body. Control your response. And the profits will follow. Because the real edge was never the setup. It was you.